So let's talk about a problem that every serious investor eventually hits. You've done all the hard work, right? You've screened the entire market. But then what? How do you actually turn that promising shortlist into a real winning portfolio? Well, in this explainer, we're going to dive into a pretty powerful 10-point framework that's designed to do exactly that.
I mean, just picture this. You've run a fantastic screen. You've somehow managed to whittle down over 4,000 companies to just 29 quality names. On one hand, that's amazing. But on the other, it's kind of paralyzing, isn't it? Your list probably has some fantastic companies on it. You know, the Asian Paints, the TCSs, the HDFC Banks of the world. All good. So what's next? Which ones actually get your money?
And that right there, that is the absolute core of the challenge. See, the goal isn't just about finding good companies. The real trick is pinpointing the great investments, and at the right time and for the right price. This explainer is all about giving you a system to bridge that exact gap.
So how do we actually bridge that gap? Well, we need a system, something reliable, almost like a map to guide us through all the noise, the financial data, the qualitative stuff, and yeah, even our own biases. And that is precisely what this framework is.
The entire system is built around just one number, 10. We are going to evaluate every single company against 10 critical dimensions. This isn't about, guesswork or gut feelings anymore. This is about a systematic, repeatable process.
And here it is. We're calling it the 10-pointer framework. Think of it as a method designed to bring cold, hard structure to what can be a really emotional decision. For each of those 10 points, we're going to assign a score, 1 to 10. And what that gives you at the end is a final, data-driven score out of 100 for any company you're looking at.
Okay, but here's where it gets really interesting. While all 10 points matter, they're definitely not all weighted the same. The framework actually puts a huge emphasis on 5 core pillars. These are the things that are the true drivers of a great investment. Just look at this, because this is where the framework really gets its power. It's all in the weighting. Notice how valuation, that's the single biggest piece of the puzzle at a whopping 20%. Then you've got business quality and financial health right behind at 15% each. You add in growth and management, and those 5 things alone make up a massive 75% of the total score. This tells you exactly where you should be focusing most of your time and energy.
So let's just make that crystal clear. These are the 5 make-or-break questions we really need to answer. First, is the company priced fairly? Second, how strong is its competitive moat? Third, is its balance sheet rock solid? Fourth, where is future growth actually going to come from? And finally, can you trust the management team? Answering these 5 questions is what separates the merely good from the truly great.
All right, theory's great and all, but let's make this real. We're now going to take this framework and apply it to a company everyone knows, just to see how it works in practice.
Okay, let's run Asian Paints through the system. Now notice the high scores for things like business quality and financial health. They're both getting a 9 out of 10. That makes sense, right? It's a strong brand with a solid balance sheet. But then, look at valuation. It only scores a 5. And this is that classic problem, a fantastic company that's trading at a pretty high price. But after we weigh all the factors, Asian Paints comes out with a final score of 75. That gives us a clear, data-backed buy rating, even with that high price. The system is telling us that sometimes quality is worth paying up for.
Okay, so we have a score, 75. But what do we actually do with that number? A score is pretty meaningless if you don't have a clear plan of action. So this next part is all about turning that analysis into a real, concrete decision.
And this is the decision metrics. It's simple, but it's so effective. That score of 75 that we got for Asian Paints, it fits squarely into this buy category, right here between 65 and 79. Now, if it had scored over 80, it would have been a strong buy. Anything below 50, it's an avoid. See? The framework just removes all that ambiguity. It gives you a clear, actionable signal. And that is the real power of a system like this. It's not just about getting a yes or no on a single company. It helps you systematically evaluate and, crucially, rank all of your opportunities against each other. You can now see with total clarity which company is your number 1 pick, which is number 5, and you can put your capital to work accordingly. But hold on, there is one more crucial step.
Deciding to buy is really only half the battle. The other half is deciding how much to buy. How do you size your positions correctly so you're not taking on too much risk?
Well, the process is pretty straightforward. That score you just calculated, the 75 for Asian paints, that becomes what we call your conviction score. And that score directly tells you what your base allocation should be. So for example, a really high conviction score, say an 85, might justify a 6 to 8% position in your portfolio. A 75, like we saw, might translate to a smaller, maybe 4 to 6% position. It's really simple. The higher your conviction, the bigger your bet.
Of course, none of this happens in a vacuum. You have to have some hard risk management rules in place to act as guardrails. Things like, never putting more than 8% into any one stock, or never letting a single sector grow to more than 25% of your portfolio. This just makes sure that even your best ideas are balanced with smart risk control.
And ultimately, that's the entire point of all this. It's about creating a system, a disciplined, repeatable process that you can lean on for every single investment you make. This is how you finally move past emotion, past those gut feelings and hidden biases, and replace them with a clear, logical structure.
So I'll just leave you with this question to think about. Without a system like this one, what are you missing? What blind spots or biases or unexamined risks are maybe lurking in your own portfolio right now?